Audio Jungle. Audio Jungle.
What are mutual funds? Do you want to learn more about mutual funds? Would you like to know how much profit a mutual fund generates? And why would an investor choose a mutual fund instead of directly investing in stocks? Don't worry, in this video, all your questions concerning mutual funds will be answered. So make sure to keep watching till the end. Hey guys, you're watching Omega Finance, where we talk about all the things revolving around investing and the world of personal finance. Many newbie investors believe mutual funds make investing and making profits in the stock market a piece of cake. And that's true. But what's also more important to know is deciding how to pick the right mutual fund so you could squeeze the maximum juice out of your investments. It is easier for them by handling investment choices on your behalf. But investing is still necessary to develop wealth. Watch on to find some of the most often cited benefits of mutual funds, which may help you decide whether or not to invest in mutual funds. Don't leave before the video's conclusion, otherwise, you could miss something important. So, what are mutual funds? In short, mutual funds are professionally managed investments that combine the capital of many different people or organizations with common investment goals. Purchases of fixed assets are made using pooled funds. Fund managers are financial experts that oversee the operations of mutual funds. It's a win-win for investors since they receive the advantages of size and profits at a cheaper cost. In addition, investors may profit from the diversification offered by mutual funds since they invest in a wide range of products. Over the last decade, investments in mutual funds have increased. Mutual funds are replacing more conventional forms of investing as a means for Indians to achieve their financial objectives. Some potential investors, however, lack confidence in knowing the best time to purchase mutual funds. Let's have a look at the types of mutual fund. Number 1. Equities or stock funds. This fund invests in equities, as its name indicates. This group has subgroups. Some equity funds are called small, mid, or large cap. Others are called aggressive growth, income-oriented, or value, etc. Equity funds may invest in Indian or overseas stocks. The company's market capitalization and expected growth rate are good ways to group funds. Number 2. Balance funds. Equities, bonds, money market instruments, and alternative assets are all fair game for balanced funds. This fund is called an asset allocation fund, and its purpose is to limit the investor's vulnerability to fluctuations in the value of several asset categories. Some funds have an allocation strategy that is set in stone. This gives investors stable exposure to several different types of assets. Some funds use a dynamic allocation percentage technique to better suit their investors' needs. This could mean changing with changes in the market. It is common to give the portfolio manager the freedom to change the weighting of the different asset classes as needed to protect the fund's stated investment goal. Number 3. Income funds. Income funds are so called because they provide a regular cash flow stream, hence the name. Most of the time, these funds buy government and high quality corporate bonds and keep them until they mature to get profit payments. The main goal of these funds is to give investors a steady income stream, not to boost the value of the assets they hold. Thus, these funds cater to conservative investors and the elderly. Number 4. Money market funds. Debt instruments issued by governments such as treasury bills dominate the money market because they are safe, short-term, and carry no default risk. However, the investor's initial capital is safe. The average yield is somewhat higher than a traditional savings or checking account and slightly lower than a certificate of deposit. Number 5. Bond funds. All mutual funds that provide a return of 1% or less are classified as fixed income funds. Government bonds, corporate bonds, and other forms of debt are the primary holdings of a fixed income mutual fund. Income from the fund's investments, such as profit, is distributed to investors. These funds, often referred to as bond funds, are actively managed and aim to make a profit by purchasing bonds at a discount. These mutual funds may provide more significant returns than bond funds, which also carry some risk. For instance, an investment fund that only buys high-yield trash bonds would be significantly riskier than one that only buys government assets. Because there are so many different types of bonds, bond funds can have very different investment strategies. However, all bond funds are vulnerable to profit rate risk. Number 6, specialty funds. Sector funds are focused strategy funds that invest in companies within a certain economic sector, such as the finance, IT, or healthcare industries. Since companies in the same sector tend to work closely together, sector funds can be volatile. Regional funds are bought when you have money set aside on a regional basis. You may more easily concentrate on a certain part of the globe. Number 7, international or global funds. Foreign funds, often known as international funds, are purchasing the funds outside their investor's native country. Global funds, on the other hand, are not restricted in where they can invest. Each nation's economic and political uncertainties contribute to varying degrees of volatility. The returns in other nations may be uncorrelated with returns at home, but that doesn't mean that they can't be a component of a diversified portfolio. So now these were some types of mutual funds. By now you might have gotten an idea of what types of mutual funds are out there. Typically, most mutual funds are into the equity market. They leverage their management expertise and let the market take care of the rest. Now, for you to have a better understanding of how to differentiate between a terrible and a well performing mutual fund, let's learn a few technical terms that help us evaluate their performance. Net asset value (NAV). The NAV of a company's stock is the difference between its assets and all of its liabilities, expressed as a price per share. The net asset value (NAV) is the price at which shares of a fund rate are exchanged on a given day, and is mostly typically used in the context of mutual funds and exchange traded funds (ETFs), registered with the US Securities and Exchange Commission (SEC). The term net assets, net worth, or capital is used to refer to the surplus of a company's assets over its obligations. NAV measures how much a fund is worth and how much it costs. It is found by dividing the fund's net asset value by the number of shares still in circulation. A mutual fund's net asset value (NAV) is a per share valuation that may be used for pricing and trading fund shares. Large cap or big cap. If a company's market value is more than $10 billion, it is called a larger cap or big cap. The phrase big market capitalization has been reduced to large cap. A company's market capitalization is found by multiplying the number of outstanding shares by the price of a share at the moment. A company's market capitalization size can be described as big, medium, small, or micro. Mid cap. Companies having a market cap, which is capitalization between $2 and $10 billion, are referred to as mid caps or mid capitalization. As the name suggests, mid cap corporations are intermediate in size between large and small cap ones. As estimates of a company's present valuation, categories like big cap, mid cap, and small cap are subject to fluctuate over time. Small cap. Shares in a public firm with a market valuation of between $300 million and $2 billion are considered small cap stocks. The specific statistics vary. Small cap stock buyers often seek young, rapidly expanding businesses. In other words, they want to invest in the future's large cap companies. Active funds. By making smart investment decisions, the goal of an active fund manager is to beat the fund's benchmark or index. To reach this goal, the manager will actively buy, hold, and sell stocks with the help of a team of researchers and analysts. It is impossible to know whether or not a certain fund manager will consistently choose assets that will exceed the market. Any investment could go up or down in value depending on how the market is doing and how the investor feels about it. Some potentially lucrative stocks may fall precipitously one year only to recover the next. The most successful active managers consistently avoid major losses despite the market's gyrations. Nevertheless, many investors' active strategies fall short of their goals. When considering an active approach, looking at a manager's long-term track record in different market conditions is important. Passive funds. In contrast, passive or tracker funds are not actively managed and instead seek a predetermined benchmark. Their primary responsibility is to provide a return consistent with the market. They are not required to outperform the market but rather to reproduce its movements. The FTSE 100, which measures the stock prices of the 100 largest corporations in the United Kingdom, is one of the most followed and quoted indexes. If the market value of all 100 firms is $10,000, then the tracker fund will acquire shares of those companies in exactly $10,000 increments. As a result, the fund's value will rise and fall in tandem with the performance of the FTSE 100 index. Passive funds returns are completely tied to index performance since managers don't have to choose which assets to keep. Therefore, a decline in the market will harm your investment. In contrast, an active fund manager may be able to respond to any market fall by withdrawing from difficult areas and hunting for better chances elsewhere. And if he misjudges it, it will be you who loses the money. Which mutual funds in India have the highest returns? The category's best equity mutual fund may consistently beat its peers. The best equity fund has the lowest cost ratio. Top mutual funds may weather market fluctuations. Alpha determines the best mutual fund. The equity fund's return was greater than the indexes. Choose an equity fund with a strong alpha compared to its peers. Check the equity fund's beta. It estimates fund volatility compared to any standard metric. Equity funds with betas smaller than 1 are less volatile. Equities fund volatility is shown by standard deviation. A larger equity fund standard deviation may indicate risk. Choose the equity fund with the greatest risk adjusted returns. To discover the best equity mutual fund, use Sharpe's ratio to compare risk adjusted returns. Now, wrapping up this video, this was all from our side to guide you about what mutual funds are, how they work for investors, and how you could pick a few beneficial mutual funds for yourself. So tell us in the comment section which type of mutual funds you invest in, and don't forget to subscribe to this channel and press the bell icon so you don't miss any exciting stuff we are posting. Omega Finance signing out.